Welcome everyone to Algo Trading Week. Now, this Algo Trading Week we kickstarted yesterday with a panel discussion on before you get into quant and algorithmic trading. It was a very interesting one, and as you can see here, the recordings are live, so you can go check it out. For today's session, we have here with us our very own Dr. Ernest Chan. So it will be a Q&A session where we'll be asking a lot of questions to Dr. Chan about how to become successful quant. Now, before we start off with the Q&A session today, I just wanted to highlight another thing. So that is our algo trading competition. Now, our algo trading competition, as you can see here, if you are interested, you can go to our algo trading week page and then you can click on get started. The moment you click on get started, you will see this page. All right, now here there is all the details about how you can join it, what is the format, how to prepare for this competition, and how it is going to end. But the very important thing that I want to highlight about this session, this competition, sorry, is that this is going to be a very good learning opportunity for those who are just starting off with algorithmic trading and are really keen to learn the basics of algorithmic trading. It's not a very trading competition sort of competition, but it's most about learning how you can learn and basics of algorithmic trading. If you are already an expert or already a knowledgeable person in the algo trading or quantitative trading space, then this can be a good opportunity for you to brush up your knowledge. So as simple as that. And the important thing is the winners of the top three winners of this competition are going to get an Amazon voucher, 15% scholarship on EPAT's next anniversary batch, then a certificate of achievement. And top 10 percentile of participants of this competition are going to get 10% scholarship in our EPAT anniversary batch that starts next month, and also a certification of achievement. Now you can just check out all these details, and there is a lot of learning material. As you can see here, there will be 3 tests, and you have to complete those 3 tests on given date, and then yeah, on the last day, day 7, competition winners will be announced. Now moving on to, I'm going to stop sharing my screen. All right, so yeah, moving on to today's session. So first of all, welcome again, and I would like to uh, uh, make a quick introduction to Dr. Ernest Chan. I'm not sure if it is required or not, but for the formalities, I'll do that. So Dr. Chan is founder and CEO of PredictNow.ai and managing member of QTS Capital Management. He has worked for various investment banks and hedge funds since 1997. Dr. Chen received his PhD in physics from Cornell University and was a member of IBM's Human Language Technologies group before joining the financial industry. He was a principal of EXP Capital Management, which is a Chicago-based investment firm. And Dr. Chan is also the author of 3 some of the amazing books in quantitative trading. If I name them, the first one is Quantitative Trading: How to Build Your Own Algorithmic Trading Business. The second one is Algorithmic Trading: Winning Strategies and Their Rationale. And the third and the latest one is called Machine Learning: Deploying Computer Algorithm to Conquer the Markets. Yeah, so that's a quick, very brief introduction. There is a lot I can talk about Dr. Chan, but I think I'll make a quick one. So again, so join our hands, and I think welcome to Algo Trading Week, Dr. Chan. Are you there with us?
Hi, Kishidi. Thank you for the kind introduction. Very happy to be here.
Wonderful, wonderful. So I'm just going to quickly explain everyone, this entire audience, the format. So I would like to highlight that I have a set of some of the most common questions here with me. And if any of you in the audience have any questions related to algo trading or quantitative trading for Dr. Chan, feel free to ask them in the questions panel. So we'll randomly pick almost all of the questions. We'll try to address all of them, the most popular ones, and then uh, yeah, I think that's about it. So I'll just straight away jump off on the first question. Uh, and that is, Dr. Chan, why is quantitative trading considered the next big thing?
Well, I wouldn't even call it the next big thing because it has already been a big thing. It has been really a dominant form of trading for the last 10 years, I would say. And from some estimates, I've heard numbers that as high as 90% of the trading volume on US exchanges are due to algorithmic trading. Granted, much of it is due to high frequency market making, but high frequency market making is a form of algorithmic trading, so we should not really exclude them. So now that does not mean in my mind that every discretionary trader should become a quantitative trader, or that quantitative trading is better than discretionary trading. But all one can say is that to ignore the opportunity to automate one strategy, to systematize one strategy, even if one were is discretionary trading, would not be wise.
Okay, so discretionary trading. Okay, so it's basically your preference, but yeah, quantitative trading has its own edges. That's what I think. What you mean? Okay, all right. So, all right. The next question is how competitive is quantitative trading for individual traders and institutions?
Yes. So as I've expressed in my first book, Quantitative Trading, and I still believe in it, that the main opportunity for a individual independent trader that can really succeed and compete against the big institution is in niche strategies. That is to say, those strategies that has very limited capacity, right? If there are many strategies where it is possible to deploy $100,000 account on it, or even $1 million account on it, but anything more than that, there would not be enough liquidity to really continue to support the revenue growth. And so those are the opportunities, for example, in OTC stocks trading, that is very popular among a lot of day traders, and such thing as maybe in certain seasonal trade that you might conduct once a quarter or once a year even. And those are really not attractive to hedge fund. Who can survive on a once a quarter kind of trade, right? Unless you make 50% in one trade. But those can be quite suitable for independent traders, because you might make a trade once a quarter, and then you have found another strategy that make another trade a quarter, and that would be a good sort of income supplement. Unless you are intending to become a trader full time, that's not a bad opportunity to pursue. So I would say that any strategy that are unattractive to a large institution, small capacity strategies, infrequent trading strategies, would still have a lot of opportunity in them.
Okay, I understand. So I have heard a lot of questions like so here the question was very simple in terms of how competitive it is, but a lot of people whom I meet they usually say that an individual trader or a retail trader, how that individual trader can compete against institutions, those who have all those technology power or stuff like that. So uh, how does that happen? I mean, can they compete against the big institutions, or are they even in a competition?
Well, that's exactly what I described, is that you have to look for this niche where the big institutions are not competing in. You do not want to compete with them. You want to avoid competition at all costs. I like the a book that is written by Peter Thiel. I think he's the co-founder of PayPal, right? And currently, I think also a co-founder of Palantir. So Peter, in his book called, I think it's called 1 to 0, put it very well. He said, highly lucrative enterprise didn't come about because of competition. They come about because they avoided competition. You do not want to compete. that is the key to success. Try not to have any competitors.
Okay, so get into competition when there is no competition.
That's right.
Okay, okay, all right. So, all right, moving to the next question, and it is also one of the most common question is, do you need a PhD to be a quant?
Definitely not.
Okay, so so on the similar line, I think Romain has asked this question. He is asking, hello, Dr. Chan. How important do you think is a PhD for quantitative and algo trading? And if doing one, how do you think a PhD student should approach the research? Thanks in advance.
I think that there are, of course, tons of research out there on different algorithmic trading strategies. But the key of any, turn them from purely theoretical and academic interest to practical interest is that you should backtest them yourself before trading them. And also to develop a intuitive understanding and understand all the various nuances of the market to tell what paper is just based on very shaky foundation. So because there's so many papers out there, you cannot possibly read them all. And so one needs to develop some kind of a filter to select the ones that are meaningful. And that filter is to be gained from reading books and trading yourself. You will soon develop a sense of what papers are just overfitting, what papers rely on faulty data, and which paper has a backtest methodology that is flawed. And there are many well-known books and blogs that discuss these kind of pitfalls, and you would be well advised to read them first before pursuing all the voluminous research that are being put out every day.
I think that's a really good piece of advice for PhD students. All right. So the next question that I have for you is a very basic and a very generic question. That is, how can I become a successful quant?
I think the key is to have skin in the game. So a lot of I have mentored and hired a lot of highly educated people, PhDs and PhD candidate and so forth. And I have found that there is, they can become great consultant in providing support to the traders, to provide analysis, to provide top, most advanced programs and algorithms. But in order to be the person who actually originate a successful strategy and not to improve or provide analytics or support or analysis for those strategy, the key is that you have to put your own money on the line. Without skin in the game, you never learn to trade, and your mind will always be focused on secondary matters such as mathematics or data science or machine learning or whatever latest and greatest theories. But once your own money is on the line, it focuses the mind and it focuses on the most basic aspects of trading. And that is why, as I said earlier, there is no need to get a PhD, because when your mind is focused on the simple things, a good bachelor degree is more than enough to succeed. In fact, I have known numerous highly successful traders, people who manage billions, who barely graduate from college, and they are quantitative traders. Does not mean that they're not intelligent, but it does mean that they are less focused on the minutiae of mathematics, of data science, of machine learning than on the market itself. They need to be singular focus on the markets, not on all these theoretical knowledge that you might gain from a PhD.
So doing practical and trying things hands-on and developing that experience is something that is required. One cannot become successful quant overnight. That is what Dr. Chan is sharing his experience here with us. Okay, very interesting. And so talking about becoming a successful quant. Now, as an individual trader, okay, there are a lot of things. I think I'm also getting a lot of questions from individual traders here. But given that we are talking about becoming a successful quant, let's first, I would like to pick a question on the career side. So, so the question that I see here is how to prepare. So this is by Roger. So Roger asks how to prepare and distinguish yourself to join the best quant funds. So you've been working with a lot of quant funds and hedge funds in the past. So given your experience, like how can you prepare and distinguish?
I think one of the more effective ways is to write a white paper on a topic with your special insights. You can write a white paper on a trading strategy that you develop, or a particular analysis of a particular market and phenomenon that you've become intrigued on. The key is original research. You don't want to report on other people's research. The key is that maybe you heard about a certain phenomenon in the market, and you set about gathering the data to validate whether that opportunity is real or not. That maybe provide a back test and so forth. So original research would be the best way to get in the door. And I've seen it. Many of my mentees and advisees gaining excellent positions in various hedge funds, and maybe also excellent programs in the Master of Financial Engineering program at the most prestigious universities through this path. There's nothing that can beat original research. Now, even some people might say, hey, why don't I just trade an account and I earn 100% return on that account? Shouldn't I be able to use that as a proof? Well, that helps certainly. The fact that you should show that you have taken, put skin in your own game and traded live, that certainly helps. Like I said, nobody can become a good trader without skin in the game. But I would say that people would also come with you with a dose of skepticism, because anybody can make a lucky bet and say, oh, last year I just bought Bitcoin when it hit a dip, and then I sold it when it doubled recover, right? And that's maybe a stroke of good luck. So a short track record, though it does tell people something, is not sufficient in itself to prove that you are a consistent and knowledgeable trader.
Okay, all right. So there is a follow question. So so then how to incorporate order flow data, if even accessible, if we are retail traders? The same question by Roger.
So order flow is indeed a good indicator, but it is not sufficient as a standalone indicator. So there are many indicators out there that people describe and promote and love, and but all of them become well known, and they are not by itself strong enough to build a trading strategy upon. So what you would need oftentimes is to incorporate it as one of many features in a machine learning program, if that's what you want to use it. Any one of these indicators by itself are now not strong enough, unfortunately, because of the large number of people that uses them.
All right. So I hope that answers your question, Roger. A very interesting question. This one is by Eyal. Have you noticed an ageism bias within the quant industry, similar to what sometimes can be seen in the larger tech industry?
Well, that's only a problem if you trying to get a job, right? So I have, all my books main theme is that you don't need to get a job if you are good at trading. So there's no such a thing as ageism if you are a sole proprietor.
Great. I hope that answers your question, yeah. There is a question by Bruno. Bruno asks, hello, Dr. Chan. Are algos still profitable these days, or does one need to add machine learning to the mix?
I do think that if you are relying on simple models, there is a alpha decay simply because of the sheer volume of people trading these simple strategies. So I would suggest that indeed machine learning is a great addition at least as a risk management layer. So that's what I've been promoting actually in the last 2 years, is that machine learning is not the best tool to generate alpha because of the easy overfitting. I mean, some people are successful, kudos to them. But I'm myself not one of those people who can generate alpha directly using machine learning. But I am quite impressed by the utility of machine learning as a risk management tool. Very successfully using it, and hope that that's the reason we launched PredictNow.ai, is to also enable other people to use it as a risk management tool. We highly discommend using it for direct alpha generation, because think about it, if we were to launch a system that can tell you whether to buy or sell Tesla tomorrow, and we sell it to $100,000, our prediction will immediately be inaccurate, because every one of those 100,000 people will compete against each other, and the signal will disappear overnight, right? So you cannot trust a machine learning system that provides trading signals to the public. But you can definitely use that for managing your own risk. So I think machine learning for risk management is the way to go.
All right. So yes, there is a combination that you can use. All right. So moving to the next question. Juan asks, does it make sense to use quant trading for low latency trading?
Well, in some sense, quantitative trading is a necessity for low latency trading. No human can operate in a millisecond domain. So only way that can work is if it's fully automated, and not only with typically C++ software is being used in that domain.
All right. The next question is again from the preparing for a career in quantitative trading point of view. So Chetan asks, "Hi sir, just need to know what skills one requires to start quant-based hedge fund."
Well, obviously, you need to have a successful track record, and I don't mean that just profitable for 1 year or half a year. Hopefully you have a longer track record than that. But beyond that, you need to have management skills because you won't hopefully be the only person managing the fund. You need to hire technologists, you need to hire researchers, you need to hire business development staff, and you need to manage them. So just having trading skills is not sufficient to make a quant fund successful. You also need to know something about business management, because there are many, many aspects of running a hedge fund that is beyond just being a good trader, right?
Yeah. Okay, so it's basically a business. So
Yeah.
you need a lot of management skills as well.
Yes.
Maybe an MBA.
And that is the sense also if you look at read a book called on Jim Simon, the founder of Renaissance Technology, you get the same sense. Jim Simon, of course, is a famous mathematician. He's still writing papers and he's extremely smart. But you will get the sense that after he certainly personally involved himself in trading strategy development when he first started the fund. But very soon his focus is on hiring other people. You read between the lines in the book that he doesn't do any research on his own on trading. Certainly not involved at the detail level in coding or anything, but one of his great skills is in identifying talent and hiring them and managing them appropriately. So this is a sorely neglected skill with a lot of quant traders. They think that they can do everything, but they can't. The most successful hedge funds are built by people who know how to manage other people.
Yes, so leadership qualities are must in order to set up your own hedge fund as well. This is something new that I never knew. Okay, all right. So the next question. Now, this is a very interesting one because it's sort of amalgamation of multiple markets. So, have you tried to understand the Indian market quantitatively? If so, what perspective do you have related to Indian market as compared to US markets or European markets?
I confess that I have no knowledge of the Indian market. And partly is because we do not have a trading staff in India, partly because of regulations. I think that even when we were trying to see about trading in index futures, I don't think we are allowed, until perhaps maybe things have changed, but we were not allowed to trade in the Indian market at all. So I confess I know nothing about the Indian market.
Very well, Dr. Chan. So, okay, next question. It's about how much in terms of time do you think we should spend on paper trading a strategy before going live with it?
Yes, that's a very good question, and it depends on the frequency of trading. So if you have a high frequency trading strategy that in and out, every second, practically you need 2 weeks to test, and you should go live if it works, because that for that high frequency strategy, every day should be profitable. But if you have a strategy that hold for days for precision, then chances are you will need 3 months of paper trading to go live, because you would need to have enough statistics to justify that to earn a confidence. You need to verify that there's statistical significance in the paper trading, just as you need to earn statistical significance in the backtest. Paper trading also requires statistical significance. So statistical significance is based on the number of trades. So you have to make sure that you have enough number of trades.
I hope that answers your question, Siddesh. Okay, this one is also very interesting. So, a recent study by Quantpedia shown that most alphas deemed profitable are mostly non-price based. Should the time series approach still be the heart of one's alpha portfolio?
Actually, I don't quite grasp the gist of the question. Do you mind repeating it?
Yeah. So a recent study by Quantpedia shown that most alphas deemed profitable are mostly non-price based. So the alphas that they create are not on price-based data. And should be so should the time series approach still be the heart of one's alpha portfolio?
Well, I don't know who published this study, and I have not, heard of it and have not read it. Maybe they have their good reasons to suggest. I'm actually quite skeptical of that conclusion, because how do they determine that it is not price-based? They don't have access to everybody's proprietary strategies. Maybe they tested their own price-based strategy and found it to be, subpar. That hardly means that there's no signal in prices. So I'm extremely skeptical of this research. But I'd be happy to take a look at it.
Yeah, it would need some study, obviously more data, then that can, that then we can come up to a conclusion. That is true. A follow-up question on the machine learning for risk management part. So when you say machine learning works well in risk management, do you mean something like a risk filter or more on a position sizing?
Both, yes. So to me, they, simple prediction that a machine learning system can make is the probability of loss for your strategy over some future period. That's exactly what predict.now.ai perform, of course. So it's no coincidence that I think that's the most important function, because from this probability of loss, you can decide whether to trade at all or decide how much capital to allocate to that trade for the next period. So there's nothing more simpler, nothing simpler than getting a probability of loss for risk management purpose.
Okay, so I hope that answers the question. The next one is I'm pursuing CFA, studying fundamentals and technicals, and already have programming experience in VBA Excel. What should be my next step to go in algo trading? Shall I go for Python or C++? How artificial intelligence fits in trading? Like there are a lot of questions in this one, but yeah, so we can pick one by one. So VBA Excel, what should be my next step to go into algorithmic trading? Shall I go for Python or C++?
Yeah, I think Python would be preferred, because C++ is really necessary only for high frequency execution. So based on your background as a fundamental, you have strong fundamental knowledge, it would seem that your talent is best deployed in developing a strategy, making use of these fundamental indicators, not in developing a high performance, low latency execution system, which is best left to a professional software developer.
Yes, so Python has more applications for an individual. 100% agree on that one. So, okay, the next one is also.
I'm also curious that why you ignore R, because Python financial, a lot of the packages related to econometrics and finance in Python are full of bugs. They are not to be trusted. Only R are trusted by professionals when they are dealing with econometrics model.
That is some amazing good piece of advice. Thank you so much, Dr. Chan. All right, so the follow-up question was how artificial intelligence fits in trading, from the same person.
Yes, so as I said, best apply to risk management and not alpha generation.
Yes. All right. Okay, so Now, a shortened question. All right, so how to find some professional quant to train our beginner team? No good reference is outside to learn from it.
I'm wondering if you can clarify. It's a question of how to hire a
So
good quant trader. Is that the question?
it's about how to train,
Or how to
how to
train?
find, yeah, how to find some professional quant to train our beginner team.
Oh, okay. Well, clearly the person you hire need to have demonstrated expertise. Now, when you say train, it does not mean that the quant trading team has to develop a new trading strategy. They could be a team that is focused on risk management. They could be a team that is focused on derivatives pricing. That could be a team that is focused on data science. So it is very highly dependent on what functions your team is doing in terms of quantitative trading. So you would need to hire expert that has a strong track record in each function. But if your goal is to have a quant team that develops strategies, that are profitable, to be blunt, my experience is that you can only hire people who already have a track record, and that is very interesting. Unless someone were able to build a successful strategy on their own, it is very hard to teach them that skill. I have tried and I have failed. So you would only want, if your goal, now again, you're not, if you're talking about hiring someone to do risk management or to do machine learning or data science, that's a different question. If you want to hire someone who actually can generate profit for you, you better hire someone who has already generated profit for themselves, because otherwise it's an uphill battle. You can just, I strongly advise that if you're a small firm, you don't waste your time and money on that. Only hire people who have track record trading on their own.
Okay, yeah. Now, so there is a follow-up question on the same one. It is like which market should be selected for such beginner team? Let's say if they are into quantitative trading, should there be any preference to start off with for beginners?
Not really. Whatever market that you feel you can understand. For example, I have a more difficulty understand the crypto market than the other person, but so I don't trade in crypto, but the other people are much more expert in crypto, so they should trade in crypto. And I am much more familiar with trading index futures than I'm in trading agricultural futures. So I let the other traders take care of the agricultural market while I focus on equity index future, and vice versa. I asked a very very, very profitable, skillful agricultural trader about some questions about the equity index market and the volatility market, and I drew a blank. So everybody have a very narrow niche, I'm afraid. And you don't, you should just pick whatever you know best. It's not that there's a market that is universally good for someone, because if it's universally good, everybody will be trading it, and overnight it will be completely efficient and there won't be any arbitrage opportunities.
All right. Uh, Moving to the next question. This is a very long one. So, Dr. Chan, do HFT traders have an edge in predicting the market direction than medium and low frequency traders? Is it easier to predict using HFT, but not everyone can have HFT setup, as it will cost millions of dollars? So, given
Yes,
that high frequency traders can have expensive setup, are they at an advantage to predict market directions?
yes, generally speaking, it is easier to predict market direction at a very short time frame than at a long time frame. I really challenge anyone to predict the direction of the I don't know, oil market in 1 year. Is it going to go up or down? Wow, that's probably have an error bar that is maybe 20% plus or minus, right? So you know, it's really hard to make long-term prediction. Yeah, but and that stands to reason. You know, if you even like predicting weather, if I see that it's already raining, I can with 99% accuracy predict that it will still be raining 1 minute from now. But if you ask me as a, you know, even if I were an expert meteorologist to predict if it's going to rain 15 days from now, I forget it, right? So same apply to market. If you could, you know, it's easier to predict where the mid price will be next second than where it would be next day, frankly. So yes, definitely high frequency trading can be much more accurate, but as you pointed out, to take advantage of that prediction is a completely different matter.
Okay, very interesting. So, okay, now this is a very personal question. So, it is pointed directly towards you. So, do you trade entirely based on algo, or some trades are discretionary too?
Well,
And sorry. Yes, you first
go ahead.
answer this question.
Yeah. So, you know, I manage a hedge fund, and as I pointed out earlier, just you know, not to compare myself with Jim Simon, far from it, but I, you know, always try to learn from the giants. And from what I learned is that you basically don't want to trade yourself after you have started the fund. You want to hire people. You want to apply your skill as a meta trader, right? It's funny because it sounds like a commercial product, meta trader. But yes, you want to be a meta trader, and the job of a meta trader is to hire traders, not to trade. And I have been extremely good at it lately for some reason. I have been able to hire traders. I have hired, you know, 7 traders, and all of them are profitable since inception. So we have developed a really unique way of hiring and onboarding sub-advisors that have, in the last 2 years, 100% hit rate. It is quite remarkable. So, you know, you have to think about hiring traders is like picking stock, right? Because when you pick a stock, it's like picking the management, picking the business, which is direction is a lot of it is determined by the management team. Of course, there are external factors. You know, if you pick dying industries, you can put a genius as a CEO and you can't really make it work. So there are external factors, but you know, a lot of it is dependent on the management. So, but picking a trader is the same. It's like making bets on stock, right? So, you know, it would be amazing if you buy 10, you know, 7 stocks and all of them go up, and that's what we did. And you know, so you know, our meta trading strategy has been very good, and but certainly you need to start as a trader before you can become a meta trader.
Okay, so talking about the hit rate. Okay, so
Oh,
the
I'm sorry.
following question.
Main question. Main point is whether it's discretionary or quantitative, and the short answer is we don't care. As long as you have a strong track record, I don't care whatever you trade, and except crypto, which is highly regulated in the U.S. But other than that, it is you know, we place bets based on the knowledge and the expertise and the track record of the trader, not on the style and the particular style that they trade.
Okay, all right. So yeah, again, so you talked about hit ratio. So so the following question is like, and also in your successful journey till now, what has been your CAGR return?
I'm sorry, I missed the crucial part of the question. The last part.
So yeah, so what has been your cumulative annual growth rate returns? So like, I guess this question is about profitability. So
Yes, so we are regulated by the SEC and NFA, and we do not disclose growth rate of the fund because of regulations. And you can ask any US manager, and they will not tell you because of SEC regulation.
all right, yes, I understand that part. So all right, so now this one is by Jun Ming. He asks, from your experience, does quant traders normally use the same strategy across all asset classes?
No, definitely not. I'm
All right.
completely opposed to using the same strategy on every asset.
Mm-hmm. Okay. Now it's a very good comparison here. So how does Python compare to MATLAB for algo trading?
Matlab is
Can
better.
all, yeah, and can all that can be done in Python be done exclusively in MATLAB?
For sure. I highly prefer MATLAB to Python, but I know different people have their own preferences. You know, language is not the most important part. You can use any language you like. You can use Visual Basic if you like. But to me, as a beginning trader, it is far easier to learn MATLAB than Python. And MATLAB has far fewer bugs than Python, and there are far more professionally prepared packages than Python. So I have no idea what beginning trader want to use Python. If they want to get a job, that might make sense. But if you're trading for yourself, there's absolutely no reason to use Python.
Okay. And how important is optimizing the transaction cost in trading strategies? What is an optimal percentage max threshold for transaction cost and PNL?
Well, I think that the main thing about transaction cost is that you can't do much about it. Frankly, you know, we sometimes trade 1,000 contracts of E-minis, and we hire specialist firms that are famous for optimizing transaction costs, and they couldn't do any better than market orders. So I frankly don't know what you mean by optimizing transaction costs, because you can't, generally speaking. You even if you leave it to the hands of experts, oftentimes they can't. You just take it on the
Okay.
chin. That's about it.
All right. The next one is when it comes to machine learning strategies, how often or on which criteria would you revise or retrain the model?
Sorry, I didn't catch quite.
So when it comes to machine learning strategies, how often or on which criteria would you revise or retrain the model?
Yes, good question. I think that you don't have to retrain it too often. I would say that you want to retrain it when you feel that the market regime has changed, or otherwise, if everything remain the same, you know, once a quarter would be quite sufficient. Because remember, machine learning takes a lot of data to train. Adding a few months of data is not going to make a big difference to the model. If it does, something's wrong with the model. But on the other hand, if there is a drastic change in market regime, you want to take into account those changes, and you would want to test whether the existing model still works in this new market regime, and if not, you might want to add new predictors, and then therefore retrain the market. So of course, you know, no machine learning system is static in terms of the number of predictors and the methodology. So obviously, you also continuously increase the number of predictors. You are improving your machine learning methodology. So every time you make this kind of improvement, you have to retrain the model. So that's a natural process. But assuming that everything is the same, you don't make any improvement in your predictor set, you don't make any improvement in methodology, you don't have market regime change, and you just everything is the same except for the evolution of the market with, you know, all these daily prices and earnings and whatever, then I think that you know, once a quarter would be more than enough. But nobody does that. So effectively, you are forced to update your model as your research progresses.
All right. So we have an individual. So he mentions that I have learned MQL4 and Excel VBA. Do I still need to learn Python or R to become a quant?
So MQL4 and what else?
Excel VBA.
Okay, yeah, I think that again, you know, if you are able to trade successfully using these tools, all the power to you. There's no urgent need for you to learn a new language. But if you want to, you know, up your game in like expanding the number of markets you trade and the opportunities that you can take advantage of, definitely you should learn one of Python, Matlab, and R, preferably Matlab. But you know, I know you may not. You have your own preference. That's fine. But so yeah, so it's not an urgent necessity, but we should always upgrade our skills, right? So we should not be satisfied with what we have. Like me, I frankly hate Python, but I learned Python. I'm, you know, I have a, you know, after I learned Python, I have more reason to hate it. So so that's But if I don't learn Python, people would say that, why do you hate it? You haven't tried it. Well, I've tried and I still hate it. So that's you definitely want to expand your horizon, even in direction that you may think is not necessarily good, so that you can have more evidence to say that it's not a good direction for you to pursue. So let's say you want to trade, you are not good at trading options, you would try to learn about option and dabble in option, and then you can have a more informed opinion of whether the option market is for you.
All right. There is a question that says, will there be a second edition to your machine learning trading book? I guess machine trading book.
So
will there be a second edition?
Yeah. So as you know, I've just published the second edition of the first book, Quantitative Trading. It has all numerous new materials and coded in Python, R, and Matlab, with some of the most advanced analytics that you can find, I'm proud to say, in the book. I'm currently focused on launching or basically making available more widely this machine learning based risk management system to everyone. I have no time at the moment to write books. So until we exit our firm, I will unlikely to have time to write a new edition, I'm afraid.
Okay, I think people are eagerly awaiting for your second edition of machine learning book. But yeah, I think before that there is an algo trading book that you also have. So you may also need to work on that second edition. All right. So this next question is again about hiring. So what is the unique skill that you are looking while picking the traders as in the asset of your team?
I'm sorry, the minimum skills that we require for.
So what is a unique skill? So is there any unique skill that you are looking for while picking a trader for your asset team?
Not really. The unique skill that we look for is a long and consistent track record. As I said, I find it an uphill battle to convert a quant to a trader. So I would rather start hiring a trader instead of a quant. But that trader can be a quant, of course, but it doesn't have to be.
Okay. We have got a technical one here. So what kind of statistical tools are helpful when you are trading at second level time frame? Is trading at this shorter time frame really random? Do you have any suggestions that are generally proven to work?
I'm sorry, can you repeat that question?
Yeah, I will repeat that question. So what kind of statistical tools are helpful when you are trading at second level time frame? So that is the first question.
At second level time frame, I think that any time series technique like auto regression, factor auto regression technique, state space models, those traditional econometric time series method would be highly useful. Common filter, that sort of thing. Yeah.
Okay, and is trading at this shorter time frame really random, or do you have like any suggestions that are generally proven to work?
No. As I mentioned before, it's far from random. The shorter the time frame, the less random it is. So
Okay.
the only problem is how do you take advantage of it? Because of another question, because of transaction costs. So yeah, the two they're all related. Highly predictable signals, but greater transaction cost per round trip return.
Okay. The next question is about execution. So there are huge technical analysis and other quant methods for entries, but would you recommend what would you recommend for exit? So can get more of the profit of trend or higher profit. So okay, I'll again rephrase the question. So someone in the audience is asking, there are huge technical indicators or quantitative methods to get into the order, but are there any recommendations for exit, like while exiting the order?
Exit depends on the strategy. If it's momentum strategy, a stop exit is suitable, but not a profit cap. If it's mean volume strategy, a profit cap profit target is suitable, but not a stop. So it's highly dependent on the strategy.
Yes. Okay. Yeah, it definitely depends on the strategy. All right. Now, someone is seeking a career advice from you. Okay. So,
But
working in.
unfortunately, I do need to jump off to my next meeting. Yeah.
Oh, yes. Yes.
Yes.
Yes. All right. So, uh, all right. So, I think there are tons of many questions, but yeah, we are running out of time. So, that's about it. And thanks for your time, Dr. Chan. In fact, I was just trying to keep track of time, but it is like uh, flawless. So happen. And thanks for your time. And I think you answered a lot of questions today, and these are really helpful. And I hope the audience enjoyed the time. And thank you so much again. And that's for it today. Thank you.
Thank you for inviting me. All right. Thank you. Take care.
Thank you. All right, so that's about it for today's session. And the interesting thing is, if your questions are some of your questions were not picked up, you can just email us or share them with us over the survey that you are going to get after this webinar, and we will make sure that all of your questions are going to get answered from our side. And uh, tomorrow we have another very interesting session by Dr. Hui Liu. So today is day 1, tomorrow is day 2, and we have till this session till next Thursday, day 7. So I hope you will enjoy them, and keep loving us, keep supporting, and thank you so much. Catch you in the next one. Thank you.